Hello students, welcome to today's session on goodwill valuation. Before we start about goodwill valuation, let me give you a small brief about what exactly is goodwill, what is the meaning of goodwill, and then we can better understand how to find out the value of goodwill. So, as we know, over a period of time, any well-established business develops an advantage of good name, reputation, and a lot of business connections. This helps the business to earn more profits as compared to a newly set up business. So in accounting, the monetary value of such advantage is known as goodwill. Goodwill is an intangible asset. So we can say, in other words, goodwill is the value of the reputation of the firm in respect of the profits expected in future over and above the normal. There are two types of goodwills: self-generated goodwills and purchased goodwill. Self-generated goodwills are invaluable. Therefore, we do not consider this type of goodwill for goodwill valuation because it's invaluable. You cannot make a value out of it. But when the second type, that is purchased goodwill, this is the goodwill which is acquired by making the payment. That is, when a business is purchased, the excess of purchase consideration over the value of its asset is the value of goodwill. Okay. Now the methods of valuation of goodwill. So usually we follow three methods of valuation of goodwill. Average profit method, super profit method, and capitalization method. First of all, we start with average profit method. So average profit method is the method where we find out the goodwill using the average profits of past few years of the firm multiplying by the number of years of purchase of goodwill. Thus, the formula for this is average profit multiplied by number of years of purchase of goodwill. How to find out average profit from this? Okay, so we have another formula for calculation of average profit as well. Okay, so this is total profit of the given number of years divided by number of years. Now let us understand this using a question. Okay. Yeah. So students, I have taken this question directly from DK Goel, right? So maybe we can use this question here as it is. I have not written it. Fine. So this question says X purchased the business of Y from 1st April 2019. For this purpose, good is to be valued at 100% of the average annual profits of last 4 years. The profits shown by Y's business for last 4 years are like this: 16, 17, 18, and 19 profits are. Then there is a loss somewhere. And for year ending to 2016, we have some thing else also. That is, after debiting loss of stock by fire, 50,000. Then for 2017 also, we have something that this includes voluntary retirement compensation paid 80,000. Verification of the books revealed the following. During the year ended 31st March 2017, a machine got destroyed in accident. 60,000 was written off as loss in P&L account. On 1st July 2017, that is this accounting year, 2 computers costing 40,000 each were purchased and one were debited to traveling expenses account on which depreciation is to be charged at the rate 10% per annum on straight line method. So using all this information, we need to calculate value of good. So first thing first, what is given to us? We are given with certain profits plus some more information, right? So that means we'll have to work upon these informations to arrive to the net profit on which we are going to calculate goodwill. Okay, so let's make a table. Table is the best thing which I find Okay. To make things very clear. So first thing first, we start from where? We start from the profit which is given to us. So profit recorded. Recorded profit is this. Okay. So we will be writing this. So this is 1 lakh, 1,50,000. Again 1,50,000 and then 2 lakh. Okay. Right. Now whatever modification adjustments need to be done will be done. So we start with the first one, that is year ending 2016. It says after debiting loss of stock by fire. Fire is what? This is the abnormal loss, right? So abnormal loss is always added. Added what? Abnormal loss, which is 50,000. All right. Okay. Then coming to the next, that is year ending 2017. It says includes voluntary retirement compensation paid 80,000. This is what? This is abnormal profit. Uh, sorry. This is the compensation paid. Compensation paid is always added to the profit. Okay. So another thing, now this is a loss, so we need to write it like this. Okay. Again, this is also added. This is for voluntary retirement compensation. This is added here. That is 80,000. All right. Then it says during the year ended 31st March, that is this, a machine got destroyed in accident and 60,000 was written off as loss in profit and loss account. Okay. So the next thing, that is add machine loss return. This 60,000. Okay. Then, 1st July 2017. Now we have come to this accounting date. Two computers costing 40,000 each were purchased and were debited to traveling expenses account on which depreciation is to be charged at the rate 10% per annum on straight line method. This means what? Number one, we have to add this value. This is the asset which was wrongly posted in traveling expenses. So we have to add this since it is an asset which has been purchased. So we need to add it to the asset part first. Okay. So this will be again added. In which year? In this. Okay. So 40,000 multiplied by 2, which makes it 80,000. Okay. Now, then it says, since it's an asset, depreciations will be charged on this at the rate of 10% per annum using a straight line method. So this depreciation will be lesser. Less depreciation. Okay. Less depreciation. So since this computers were purchased on 1st July 2017. So for this accounting period, 2017-18, the depreciation will be charged for 9 months. That is July, August, September, October, November, December, January, February, March, 9 months. So for 9 months at the rate of 10%, this value would be 6,000. Since this is an asset, so the depreciation will be charged next year also. For the whole year at the rate 10%, that is, this becomes 8%. Now, no more adjustments will be made. So now finally we arrive at calculation of adjusted profits. So the adjusted profits here would be this much. 1,50,000, 1 lakh plus 50,000, 1,50,000, right? Here, this is minus 1, minus, sorry, 1,50,000 plus 1,40,000. 8 plus 6 is 14. 1,40,000. So what is left is minus 10,000. Okay. Then for this year, this is 1,50,000 plus 80,000. This is 2,30,000. 2,30,000 minus 6,000, 2,24,000. And here it is 2 lakh minus 8,000, 1,92,000. Now, so the average profit has to be found on these. Okay, so now let's talk about calculating the average profit and then finding out the value of value of goodwill. So now let's find out average profit. Average profit will be sum of all these numbers plus, then this would be minus, so I'll simply write minus here, 10,000, then plus 2,24,000 plus 1,92,000, okay, divided by both. Let's do a quick calculation to this very quickly, okay. So this is 1,50,000 plus 2,24,000 plus 1,92,000. This comes to 5,66,000 minus 10,000. This comes 5,56,000. So this is 5 lakh. So we were talking, yeah. So the adjusted profits that we have arrived here is 150, this. And we have used this, summed it up and averaged it out. 1,39,000 is the average profit. Now, as the question says that goodwill is to be valued at 100% of the average annual profit of the last 4 years. So that means goodwill is equal to average profit, that is 1,39,000. Now, suppose instead of this, the question would have said that the value goodwill is to be valued at, say, 3 years of purchase of goodwill. Okay. So what would have been? Suppose this question had said that goodwill is to be valued at 3 years purchase of goodwill. Okay. Yeah. Then what would have been the value of goodwill? In that case, we would have used this formula, that is average profit multiplied by number of years of purchase of goodwill. Okay. So this would be 1,39,000 multiplied by 3. And in that case, the answer here would have been, that is multiplied by 3. Answer would have been 4,70,000. Okay. This is how we calculate goodwill using average profit method. Now the next method is super profit. All right. The super profit method, super profit is what? Super profit is the clear-cut profit which is arrived by subtracting normal profit from the average. Okay. So the formulas for this are super profit is average profit, normal profit. And how do we calculate goodwill here? That is super profit into number of years of purchase of goodwill. Then how do we calculate normal profit? Normal profit is firm's capital multiplied by normal rate of return upon, that is R upon 100. Okay. Now, so let's take a quick question here. Okay. So I've taken this question here, and it says two partners, their combined capital is 2,50,000. Normal rate of return was 10%. Profit of last 4 years is given. This closing stock for the year 2022-23 overvalued by 5,000. Goodwill has to be calculated for 3 years purchase of last 4 years average super profit. Okay, so let us start working this. Yeah, now. Now, this says for year 2022-23, the profit was overvalued, right? So, therefore, what I'm going to do is, I'm going to simply, okay, this here, this would be minus 5,000 because this much is overvalued. So, the profit, adjusted profit here is 28,000. Now, what do I have to find out? I have to find out, first of all, average profit. Again, using the same value, I will sum it up. Okay. So this is 35 plus 25 plus 32 plus 28. Let's do the calculation very quickly. This is 35 plus 25 plus 32 plus 28. And this comes to 1,20,000. So 1,20,000 divided by 4, that is 30,000 is my average profit. Now let's find out the normal profit. Okay. So normal profit, the formula for normal profit is firm's capital into R upon 100. Now firm's capital is 2,50,000. R is 10%. We will use these values. This is 2,50,000 multiplied by 10 upon 100. Now this comes to how much? This comes to 25,000. Okay. Thus, super profit is equal to 30,000 minus 25,000, which comes to 5,000, and goodwill is 5,000 multiplied by 3 years purchase. So this is 3 years. So this becomes 15,000. This is my goodwill calculation using super profit method. Okay. Now let's talk about the third method quickly. Okay. Third method is capitalization method. The capitalization method means the profit is capitalized, average. So here we use both the types of profit, that is average profit as well as the super profit. So first of all, we start with average profit. Capitalization of average profit. Okay. Now the formula for the calculation of goodwill here is, that is capitalized value of average profit minus current value of capital. How do I find out the capitalized value of average profit? The formula is average profit multiplied by 100 upon R, where R is the normal rate of return. And current capital is for, that is assets minus simple capital. Formula that we used to use earlier also. So these are the three formulas for this. Now I'll take up the question. Again, I've taken the question from DK Goyal only. So this says There are two partners in the business. Balance in their capital and current account is given. Profits of last 5 consecutive years ending 31st March are all these. General reserve appeared in the book at 50,000. Normal rate of return is 10%. Goodwill by capitalization of average profit method. Okay. So first of all, what do I need to find out? Capitalized value of average profit. So how do I find capitalized value of average profit? So you need to have average profit. Average profit of that is 60,000. Then there is a loss of 40,000. Okay. So now let's find out the average profit first. That is 60,000 minus 40,000. This is 20,000 plus 1,30,000, which is 1,50,000. Okay. And let me calculate it very quickly. So 60,000 minus 40,000, that means net of 20,000 is left here, plus 1,30,000 plus 2 lakh plus 2,50,000. This comes to 6 lakhs divided by 5. So average profit is 1,20,000. Now finding out the capitalized value from this is formula would be average profit multiplied by 100 upon R. R is 10. So this is 1,20,000 multiplied by 100 upon 10. That is, we have to multiply 1,20,000 by 10. Multiplying this, we get 12 lakh straight. Okay. Okay. Now we need to find out that what next we need to find out here? Current value of the capital. So now we need to find out the current value of capital. Current value of capital, that is the sum of capital accounts, current accounts, and generals. Okay. So now this is 5 lakh plus 3,50,000 plus 80,000. And here in case of Kuber, current account has a debit balance. So that will be subtracted, and then reserve is 50,000. So the total comes here is 9,60,000. Right? Goodwill is capitalized value of average profit minus current value capital. So goodwill will be how much? This is 12 lakh minus 9 lakh 60,000. Okay. And the answer would be 2,40,000. So this 2,40,000 becomes the goodwill of the firm using capitalization of average profit method. Now, the last method to be taken, that is capitalization of super profit. Super profit, we have already seen what is super profit. So, super profit in itself is actually the value of goodwill. So, if we have to capitalize this value, how do we do this? The goodwill, how do we calculate goodwill? That is super profit into 100 upon R. And super profit is simply average profit minus normal. Okay. So, if we use the same question which is here, we have average profit and we have normal profit also. Normal profit is how much? How do we calculate normal profit here? Right? So, average profit, if we use the same question, we have average profit to be 1,20,000. Right. And normal profit will be, that is, value of capital is given to us, which is 9,60,000 into R upon 100. So this would be 9,60,000 into 10 upon 100. Okay. So how much do I get here? This becomes 96,000. Okay. So my super profit will be 1,20,000 minus 96,000, which is equal to 4,000 and 20 more, 24,000. Okay. Now value of goodwill using capitalization of super profit. Super profit is given to us as 24,000 multiplied by 100 upon 10. This becomes 2,40,000. See, the answer is C, using both the methods. Okay. Now, so students, this is all for today. Students, I hope so students, this is all for today. I hope you understood the topic. For any other query, you can come to my Urban Pro page. Thank you very much.